Aging in America is expensive. Between assisted living, in-home nursing, and out-of-pocket medical expenses, the cost of long-term care routinely drains decades of carefully planned retirement savings in a matter of months. When the parents run out of money, the financial weight falls directly on their adult children. Statistics show that 58% of family caregivers incur personal debt, often taking on $5,000 or more just to keep aging parents housed. This chart visualizes a massive contradiction in family assets. On the left, a small bar represents $5,000 of caregiver debt. On the right, a towering volume represents $112 billion in active life insurance value seniors abandon annually. People let these policies lapse for very practical reasons. The original need for the insurance has usually passed, as the children are now grown and financially independent. Meanwhile, the policy premiums escalate rapidly, becoming impossible to maintain on a fixed retirement income. Faced with these rising costs, seniors usually choose between two highly destructive options. They either stop paying and let the policy lapse entirely, receiving absolutely nothing, or they surrender it back to the insurance carrier for a tiny, fractional cash payment. The very financial instrument they purchased decades ago to protect their family's future ends up acting as There is a third option, known as a secondary market life settlement. This is a regulated financial transaction where a policyholder sells their unwanted life insurance to a third-party investor for an immediate cash payment. Not everyone qualifies for this market. The ideal candidates are seniors aged 70 or older who have experienced a moderate decline in their health since the policy was first issued. This flowchart maps out life insurance structures. To qualify for a settlement, the secondary market targets three branches: universal life, whole life, and convertible term. These specific policies require a minimum death benefit of $100,000 to absorb institutional costs. Meeting these age, health, and structural benchmarks categorizes the policy as a tradable financial asset, making it eligible for valuation on the secondary market. You have likely seen daytime television commercials offering to buy life insurance policies for cash. These companies operate specifically as direct buyers. Direct buyers operate with a built-in conflict of interest. They owe their allegiance to institutional investors, which means their explicit goal is to acquire the senior's policy for the lowest possible price. Because they operate on a single buyer model, they offer a take-it-or-leave-it payout. Without competition driving up the offer, the final payout to the senior is severely suppressed. The alternative to a direct buyer is working with a licensed life settlement broker who operates under a fiduciary standard. A fiduciary is legally mandated to protect the policy owner. Because they sit on the same side of the table as the seller, their sole objective is to maximize the final cash return. This diagram visualizes how a fiduciary maximizes payout using a proprietary auction platform. The broker takes the policy to the open market, forcing global institutional funds into a bidding war. The result? Auction payouts average nearly 9 times higher than baseline cash surrender values. The mechanism chosen dictates the financial outcome. Direct buyers extract wealth from seniors to satisfy investors, while fiduciary auctions force the open market to maximize the cash return to the policyholder. Utilizing a fiduciary broker effectively replaces an expensive liability with an immediate cash windfall. That sudden liquidity connects directly back to the initial elder care crisis. It provides the heavy capital necessary to fund long-term care and secure in-home nursing without forcing the senior to sacrifice their lifestyle. Simultaneously, this windfall lifts the crushing financial stress off the shoulders of the adult children, eliminating the need to take on thousands of dollars in personal debt just to support their parents. A life insurance policy often serves as a final financial reserve, providing the capital required to fund a retirement that has outlived its original budget. To find out if your policy or your parents' policy qualifies for a settlement, click the link in the description. You can take a brief, secure digital assessment to evaluate your unneeded policy and uncover its true secondary market value.